Good morning. This is Ken Long from Tortoise Capital with a review of the weekend trading reports for July 16th, 2016. The market is in bullish normal conditions on an annual basis with weekly RSI. We're the higher end of normal at 65 out of 100. That number has been creeping up lately. On a 10-day basis, using the 10-day NDX, we are overbought at 88 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average is a very strong green bullish at 7.13%. Slope of the 50-day moving average is improved to white bullish at 0.51. ADX is a neutral, non-trending 17.5, but with bulls in charge. The risk index is the 30-period moving average of the VIX divided by the 10. The threshold between risk on and off is 1.0, and the current reading is at 1.222, so we're deeply into risk on. We take that score of 1.22 and look at the last 5,000 trading days. We find the average and the standard deviation and compute the z-score of the risk Z, and that's at 2.46. So that means we are 2.46 standard deviations above the long-term historical average for this indicator. Here you see a 90-day histogram, and we have recently moved from a minus 2 sigma to a plus 2.5 sigma. The change in the posture of risk off versus risk on in the last 10 days is almost 4.5 standard deviations and shifting away from pure fear to the relief rally response. Blended monthly rebalancing, you can see the holdings, which will be reevaluated on or about 1 August. These are the current readings for these different populations of ETFs on the basis of Friday's closing price. In ETF 2, the theoretical exposure of the market is at 90%. Model portfolio itself is at 100% exposed with stops in place. Here's a quick look at components of these various blended monthly rebalancings. You can see everything is on a buy signal right now, with Latin America, Brazil, real estate, Australia, small caps in the lead. This is the ETF Max through the same lens. This is the top 40 or so ETFs from the 1,000 ETF database. See, there was been some pullback here in the metals and mining sectors and the precious metals, but they've had quite an extraordinary month, 3 months and 6 months, so they still remain at the top of the stack. Big winners now, the basic metals and minings, coal, Brazil small caps. So that's an area of continued performance. Here's cotton has had quite a 1 week and 1 month performance, as is nickel. Weakness here in the German Bund and in the coffee ETF. The S&P 500, the top 50. Quite a move here in Freeport Moran in the last week, month, and 3 months. And in Applied Materials. And certainly in the Williams Company, WMB, with a 13% week. Kinder Morgan up almost 9.5%. Looking at the market health check, the vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal purple line reflects what was once the swing high, all-time high, and now this week we exceeded that in the response as the response to Brexit continues to push the market now higher than ever before. Current support level I place here at the red line at the bottom of the river and the floodplain, excuse me. You can see the 200-day moving average starting to be left behind now, as we are now almost 7%, 7.5% above that. You can see the slope of the 30 has now become positive again and inching higher, though still not at dangerous levels. ETF2 regional report. 9 out of the 10 sectors are on buy signals. Only European 350 are negative. So we are at 90% invested, 10% cash in the theoretical model, up from 70-30. The S&P at 22 is stronger than the globals at 18. Inside the U.S., it's small caps, mid caps, large caps, followed by tech. That's an inversion of earlier in the year when it was all the large caps all the time, and the U.S. small caps were suffering. So that's now the U.S. small caps have moved to the top of the stack along with Latin America. In the market mosaic, some strength here in the U.S. small caps and mid caps, as noted. Strength across the board in Asia, except for China, and most everything in Europe is below average still. Very strong in Brazil, Latin America, silver at the top of the stack in the alternate asset classes. ETF2 lens for the ETF top 30. We'll be looking for new emerging leaders among Alcoa, Russia, natural resources. There is some weakness creeping here into oil and gas exploration, along with oil starting to weaken. The Dow 30 looked at through the same lens. None of the U.S. large caps in the Dow are among the highest in the green, so there's no green here. Weakness at the bottom in Microsoft, Nike, and Apple. Some slight improvement here in Disney, that it's now yellow and red. And improvement in Intel, white and yellow. And some weakness creeping here into United Health and Chevron. Shifting to the daily report, there are really no pattern trades because of the strong close on Friday. There has been no retracement that allows for a trade frame. Again, you can see a couple of overreaction short positions being fired. I would wait to see actual evidence of price collapse intraday rather than just shorting at the open. In the ETFs, there's a couple channeling and overreactions, a 5-day down in the VIX, a triple screen in treasuries, and 2551Ws in gold and utilities. See the regression line fractal framework. The top shelf are the 5 symbols in each population that are the most below their own RL270, so these are deep discounted value plays. And the bottom shelf in the red are the ones that are the most numbers of ATR above their own long-term fair value, so these would be the relative strength leaders. And in both cases, we're looking at the extremes in those populations. We can use that RLCO framework to take a look at framing this nice swing trades. No squeezes available. See that powerful move out of Brexit. We're still kind of clustered in terms of the slope of the 30, still clustered around the long-term average, although we have crossed its own 10-period moving average and starting to stretch out. You can see the Brexit move reflected here in price relative to the 200. Just some stats to review. Looking at the z-scores of 3 regression line slopes here, normalized against the their own volatility. You can see the price has jumped completely out of the river. River starting to expand. The 10 period regression line. There could be even some more available here. You can see the 10 is starting to hook up. That would be unusual. The slope of the 30 has increased. The 90 had pulled almost back right to the to its zero line, but is starting to improve as a function finally of gaining some traction. So I take that as a long-term favorable posture. And that's everything I wanted to cover for this weekend report. Get the market call correct. It's at dangerously high levels. Showed a little bit of evidence of temporary weakness there on Friday. The news from Turkey didn't look like it was going to help, but they may be resolving the coup attempt, and so that there may be actually some relief in the markets on Monday. So keep your risk measured and your powder dry.